This is Shared Accounts with CU Times. I'm Michael Ogden, editor-in-chief at said publication, CU Times, on our radar for the month of January 2024. Oh my gosh, it's 2024. We are driving and diving into auto loans. Why? Because it's a volatile time in the auto lending arena. Delinquencies are up, rates are up, things are looking a bit bleak in the near term, but honestly, things have been bleak for most of 2023. But hope is dangling itself out there in the months ahead. Today, we're going to crunch some auto loan numbers with the person you all need to know better. Welcome to Shared Accounts with CU Times. In the virtual studio today is our own lending reporter, Jim DuPlessis. I invited him in because 1, he's smart, 2, he's a data cruncher. I am not. 3, I wanted you all to hear kind of some of our, what our discussions are like in the newsroom. And 4, I like his southern drawl. Reminds me of home. Jim, Happy New Year and hello.
Well, Happy New Year to you too from South Carolina's beach.
Oh, yeah. You are definitely out in South Carolina. That is your home state. And you're going to be joining us off and on here throughout the year. But first, before we get into it, Jim, I wanted to get your quick take on the auto lending landscape for credit unions right now.
Well, it actually looks pretty good. Cox Automotive last week released its forecast, and they're basically saying they expect it to be normal, which is actually great news because it's been very abnormal.
Yeah, yes, it has. That's a good place to pause. And thanks for mentioning Cox Automotive because I want to let everybody know that this episode of Shared Accounts with CU Times is sponsored by Cox Automotive. Cox Automotive is the world's largest automotive services and technology provider, connecting 22,000 dealers with more than 1,600 lenders and 220 aftermarket providers. Fueled by the largest breadth of first party data, fed by 2.3 billion online interactions a year, Cox Automotive tailors leading solutions for car shoppers, automakers, dealers, retailers, fleet owners, and lenders. The company has 25,000 plus employees. Those people are on 5 continents, and they have a family of trusted and connected brands that includes AutoTrader, DealerTrack, Kelly Blue Book, Manheim, Next Gear Capital, and V Auto. To learn more, visit coxautoinc.com. That is coxautoinc.com, or connect with them over on X/Twitter at Cox Automotive. And then also you can find them on Facebook and, of course, on LinkedIn. So thanks, Cox Automotive. So, auto loans. Let's jump in. Jim, we saw some interesting developments happening in 2023. I want to talk about credit union market share first up for auto loans and what you've been seeing there with all the reporting you've been doing.
Yeah, first, credit unions did a fantastic job with market share from 2021 to 2022. And they set records for their market share both in new and used. I mean, at one point, we're the leading overall lender for automobiles. They've always led in the used car market, but it was unusual for them to gain so much in the new. And that has totally reversed in the last 12 months as the interest rates ratcheted up so rapidly. They lost a lot of their new car market share, and they've lost even a little bit of their used market share. At the same time, captives have gained a lot. And I kind of always think that when the captives do, everybody else has to follow, get out of the way. So the overall question is, how much of this is all by design from the credit union management, or how much is credit unions losing share because of better competition?
Well, that's an interesting question, Jim. I think we've talked about it a bit before on our newsroom calls. So, do you think this market share issue could actually be something planned?
Absolutely.
Yeah? How so?
conversations with some folks, and also, for example, the banks. Wells Fargo is very open in saying that they've lost their originations are down and their balances are down primarily because they've tightened the box for their criteria for auto loans. And they've also, they say some of it's been due to price competition. I don't think that's unusual. I think that a lot of lenders, including credit unions, have tightened the box, and their underwriting is much stricter than, or some stricter than it was a year or so ago. And that may be a response to other factors like rising delinquencies or concerns about future.
Okay. I think that's a fascinating take that the market share topic is actually being potentially manipulated a bit by credit union leadership. On the flip side of that, I would think we'd be remiss to just say the market condition has just been bizarre for credit unions this past year.
Yeah, and that's actually been good in some ways. The fact that the rates were rising has also been contributing to higher net interest margins. And so, in a rising rate environment, certain things happen, good and bad. And now we're going into apparently a declining interest rate pattern.
Yeah. 2024, we'll talk about that here in a few minutes, but we absolutely should be heading into that environment after this really insane high rate year in 2023. Can we talk about securities for a minute? Because you've done basically all the heavy lifting about securities and reporting for us over the years. And you had just a few weeks ago in December, you had a story about Space Coast Credit Union out of Melbourne, Florida. They had a huge auto loan securities deal go down. Can you kind of set the stage for that?
Yeah, it was only a couple years ago, I think 2019, that the first asset-backed security, and the asset being auto loans, was completed by a credit union. And there were none in 2020, and then there were a few in 2021 and 2022. But this year, there was a bunch of them. I think there were 7 deals that were completed this year that we know of. And it topped $1 billion. So that's, for credit unions, that's a lot.
Yeah, so and to clarify, we're recording in 2024, but you say this year, it was actually just a few days ago. It's like writing checks. You know how you used to write checks, you would write the wrong year. We don't do that anymore. Anyway, so in 2023, credit unions sold over, I think, about 3 billion in auto loan backed securities. So with this deal with Space Coast, it was like 422 million. What does that indicate to you, again, with the 7, 8, or 9 credit unions in 2023 that sold securities? What does that signal to you?
Well, one, I think it signals that credit unions are becoming more sophisticated in their operations. This is another tool for them to generate some cash and be able to lend out money again. That's especially important when loan to share ratios are so high. Although, when I look at individual credit unions, the amount that moves the needle is not that much, but it helps. And for some credit unions, this may have other advantages. In any case, one of the things I'm curious about is how much of this is due to the fact that now rates are have peaked and are headed down. So what they're selling is kind of premium priced loans. Whereas before, if you sold a 3% mortgage, for example, it didn't have that advantage.
Right. The other thing is, in your reporting, and looking at the data, it appears only the bigger credit unions are actually doing these auto loan securities deals. Is that correct?
Well, yes and no. I mean, there have been some smaller in the sense that they're less than 10 billion in assets. I can't remember the number off the top of my head, but Space City it's not a huge credit union, and several of them are not. So I think too, some of the folks who advise credit unions, some of the folks that have been in this business a long time, see credit unions as a growing market. So they've been reaching out and aggressively trying to encourage credit unions to go down that road.
Yeah, Space Coast down in Melbourne, they're fairly big. I don't have the NCAA data right in front of me, but it looks like they had about 4.6 billion in total auto loans by the end of September. according to our reporting here. And 89% of those were indirect. So they're not small, they're not the biggest, but they're doing really interesting work there.
Space Coast, by the way, their size and assets is one thing, but their rank as far as auto lending, it's very high, especially with indirect lending. So all of that issue was indirect loans. That's saying a lot.
Let's move on to a couple of other things that have also come out. Again, your reporting in December, Jim, was incredible. You did so much. There was so much data dump that happened before the holidays. But I want to talk about two things. One was CUNA's monthly credit union estimates that came out mid December. And by the way, now it's not CUNA anymore, it's America's Credit Unions. But for our sake, it's CUNA because that's who published the report. In that particular report that came out, again, it was around December 13th, they were showing that credit unions had one of their weakest months in October. This is Q3 data, as savings balances fell and loan growth lagged. When we look at that, the main thing that popped out to me from your reporting was that total car loans actually grew but fell from September compared to the average, as you reported, the October gain. This is all to say the last time auto loan balances fell for two consecutive months for credit unions was back at the start of the pandemic. So what was your take from when you saw this report?
Well, I love to play the pessimist, but I looked at those numbers and I started to wonder are we seeing the trough? Although these numbers are really bad, are we seeing the combined effects of this rapid rate increase and inflation? Car prices have been going up, although not as much. And in new cars, the price increases haven't been, has actually been declined a bit. But are we seeing the worst of that? So,
What do you think? Do you think we're seeing the worst?
well, if rates continue going down, and they seem to be beating expectations, I think some of the forecasts I've reported on, both from the mortgage bankers and from CUNA, or what was CUNA, and some others, when they predicted rates for the end of the year, we were already lower than that as we were reporting it. So I think it's possible that we'll see some big changes this year because of rates falling and inflation falling.
Well, we'll take a look at what we think is happening, might happen this year in a moment. But when the pandemic started, I mean, that was its own chaos, and now we're 4 years later. Were you surprised at all that we saw these two consecutive months where the auto loan balances fell for credit unions? Or were you just like, eh?
I mean, I was. I mean, I look each time I do this to see what are the numbers telling me. I mean, I always want to see the latest incremental data because that's where the news is. So when I see something like that and I look at what's the pattern, do we normally have a drop like this from September to October or from August to September? And the answer is no, we don't. This was far outside of the normal. If you go back, say, 7 years, just looking at those particular monthly changes. So it's definitely consequential.
Well, on that note, obviously we haven't seen Q4 data yet, but is your Jim eyeballs looking for another consecutive drop of auto loan balances in Q4?
This is where, yeah, it falls apart for me. I don't know. My sense is that things are going to kind of look flat for a little while or up and down. There's not going to be as significant changes. We're always getting numbers that are 2 or 3 months old. So the next numbers we'll get are for November, which is before the last Fed meeting where they clearly signaled they were going to be lowering rates at a faster pace than the market had expected. So I would think that it might not be that much different in November, or it could even be worse. Who knows?
Who knows?
But we would start to see those changes occurring in December and January, in February, assuming no other, I call it black swan events, that is, war or pestilence or natural disasters occur. And I get scared when I watch the news these days. So we don't know. But if everything is as it has been, it kind of looks like it might get better.
There's some hopeful Jim news, but kind of keeping with that theme about the downward trend we were seeing and could see, we don't know yet. But the loan quality, I want to ask you about that. What have you been seeing when it comes to the loan quality and delinquency rates? Tell us what you've been reporting there.
Yes, last thing I did before I got on this call was to run the numbers again on auto loan delinquencies for credit unions in 2018 and 2019. So, yes, these delinquency numbers are up a lot at credit unions, and I think they're up also at banks. But for credit unions, the problem is in the used car market. The new car market delinquency rates are just dandy. They're in the 40 basis points range. 0.42% as of September 30th. And that's up from a year ago and it's up from the second quarter, but compared to 2018, 2019, it was like 43 and 47 basis points. So we're doing okay. Used, it's up, and it's up more than it was pre-pandemic using December numbers. So it was 0.98% September 30th, which is up from June and up from a year ago, which was no surprise. But is it worse than life before the pandemic? And the answer is yeah, it was. It was 2018 ended at 0.82%, 2019 ended at 0.86%. So those rates are higher. I just want to know a little bit more about what credit union folks are seeing as the issue. What are these buyers? What's happened with them in their lives?
Yeah, in future episodes this month, since we're focusing on auto loans, I'm going to be asking that specific question to credit union CEOs I'm talking to. So hopefully we get some answers there. Does the delinquency issue, does that overshadow any of your minor optimism that you have going forward?
I'll say no, and I'll tell you why. I was looking at some of the earnings call transcripts again from Wells Fargo and J.P. Morgan, among others, but neither one sent out signals that they were concerned about the levels of delinquencies. And if they're not worried, I'm not as inclined to be worried because they report on this and they report more thoroughly than credit unions on their results, and they're not seeing that. Ally Financial sounded like they were okay with where things were as far as loan quality.
Well, I know NCUA Chairman Todd Harper, he's raised some concerns about the delinquency stuff, but as you said, we will be getting a new batch of numbers, but those will only reflect to November. Those will be coming out pretty soon. So, Jim, I want to look into 2024. We are hours into it right now, into the new year. Forecasts from Mortgage Bankers Association, NBA, and again, CUNA, formerly known as CUNA, like Prince, they are both seeing and predicting falling interest rates, like you mentioned with the Fed. But the MBA is still holding on to this recession prediction for the new year. CUNA has backed off, it seems. What are you seeing on this front? Because it's been confusing as hell this past year.
I'll just comment as a spectator, the fan view here. One thing is, I don't think there's that big a difference if you were to look at their numbers for what they're forecasting for economic growth, or in the case of NBA for declines. They're very tiny declines that NBA is predicting for the first and second quarters. And they've been predicting this 2-quarter decline for more than a year, anyhow. And it's sort of kicking the can down the road. But their models show them certain trends, and I think this is what the model tells them. CUNA had predicted, I think, slowing. They're similar. They both predict unemployment will rise next year, and that's a lagging indicator, but one that's going to affect, obviously, lending. But Cox Automotive, Jonathan Smoke was pointing out, yeah, unemployment will rise, but they're still not expecting it to reach a level where it affects spending. In other words, they feel like demand is sufficient that modest increase in unemployment isn't going to ruin the overall market.
So, do you think, as far as auto lending goes, are you keeping your eye more on delinquencies or are you keeping your eyes on rates or both?
Well, delinquencies for sure, because it's still a coin toss. I'm thinking, although I tend towards pessimism, it kind of looks to me like it's still in the normal range. But if it does continue up, then it's obviously a very big problem.
All right, Jim, I want the audience to kind of know you a little bit better because honestly, you're possibly just a name out there, but you are a real person in South Carolina, and I want our audience to know you more and better as we go through this new year. And I wanted to ask you, when you're not data crunching credit union numbers, what are you doing? Like, what's your hobbies?
Well, ideally, if I'm not and it's not raining, I like to be on my bike. And also, I like to do yoga. Both of them are real important to keep my head clean. And I'll do home repairs. I do a lot of variety of home improvement projects.
I also want to ask, what's the last movie you watched?
I think one of the last I saw in the theaters was the movie about the Oklahoma tribe in the 1920s.
Oh, Killers of the Flower Moon.
That's right.
Would you recommend?
Yes, I think that was a fascinating movie.
I haven't seen it yet. Jim, I appreciate you very much. I'm glad you were on with us today to kick this month off of auto lending coverage on this particular podcast. So thank you so much. This episode has been sponsored by Cox Automotive. Check them out online or on their socials. Please subscribe to Shared Accounts with CU Times anywhere you get or listen to your podcasts. Apple, Amazon. I do miss Stitcher, though. You know how this all works. Anyway, if you want to rate us, please do. We love it. We love your feedback. For those of you with questions or comments, feel free to email me over at mogden@cutimes.com. That's M as in Mary, or in this case, Michael, Ogden@cutimes.com. I don't do Twitter anymore. It's a mess. Thank you to our producer, Jeff Metz. Thank you all for listening. Talk to you next week.